To welcome you to our IPO pitch for Revolut. Since launching in 2015, Revolut has raised more than £1.25 billion in equity from the primary capital market. And because of this, Revolut's debt-to-equity ratio stands at a very low 0.02. At a glance, this figure suggests that Revolut has minimal leverage, so it'd be better placed raising debt in order to take advantage of the tax shield. However, due to the firm's negative cash flows, Revolut has a negative 2.1 interest coverage rate, meaning that although Revolut currently has a capital structure similar to other firms in its sector, it does not produce enough cash flows to meet its interest expenses. This makes raising debt riskier, as Revolut's cost of financial distress would consequently go up as well. In line with the trade-off theory, here the cost of debt, namely the cost of financial distress, does not outweigh the benefits of debt. Thus, Revolut is better off raising equity instead of debt. The CAPM model describes the relationship between the expected return of an asset and its exposure to systematic risk. Under this model, beta can be seen as an estimate of how risky an investment is. The higher the beta of an investment, the more sensitive its return is to that of the market. As the FTSE 100 indices is the value-weighted index that contains all risky assets, we chose the yearly closing price of the FTSE 100 indices from 2016 to 2021 in order to calculate the market's portfolio return rate under the CAPM model. We then calculated the beta based on our findings from the returns of both Revolut and the FTSE 100. As for the risk-free rate, we used the UK 6 months Treasury bill as a benchmark and took into account the inflation rate when calculating our CAPM. From this, Revolut's expected return rate is 46.4%. Individual stocks should be chosen based on their contribution to portfolio risk and return, as shown by the securities market line. As a result, the securities market line effectively graphs the CAPM's theory conclusions. The x-axis indicates risk beta, and the y-axis shows projected return. The intercept represents the market free rate, whereas the slope represents the market risk premium. In order to determine the value of Revolut, we conducted a discounted free cash flow model. We began by inputting some historical data from Revolut's financial statements in order to gain an understanding of how cash flows have changed over time. This is represented by the black bit of the chart. From this data, we were able to infer some assumptions as to the rate we can expect future cash flows to grow at. This is shown in orange. Perhaps the most important assumption is the sales growth rate of 23%, a figure that we arrived at based on industry-leading research. We then used these assumptions to forecast the future cash flows for Revolut. These are shown in orange on the graph. From the free cash flow equation, we can see that the cash flows are discounted by a factor known as the WACC. This figure reflects Revolut's cost of capital, which we calculated based on the market value of Revolut's debt and equity. The return on equity was determined by the CAPM model. Lastly, from the equation, you can see we must assume a terminal value for the final cash flow, a figure which represents a perpetual growth rate for Revolut. We've chosen 15% as the growth rate for Revolut because in the long term, we believe that the predicted sales growth rate of 23% is not realistic, and this growth will slow down as the firm matures. Once all the cash flows are added together, our valuation model gives us a negative valuation of £33 million. Revolut was valued at £4 billion in the last funding round in late 2020, and this is much higher than our valuation of negative 33 million that was estimated from our FCF model. This is largely due to the fact that the free cash flow model can underestimate the value of firms in their infancy stage, due to the fact that these types of companies do not have proven cash flows because they're aggressively expanding their business models. We considered doing a comparable valuation, however, we decided that this was infeasible due to the fact that there are a lack of other similar companies that have gone public in the UK. Therefore, we thought the most accurate valuation to use would be the figure of £4 billion from the last funding round. We also found out the price per share based on the last funding round's share price. We believe that Revolut should raise £500 million in order to finance their expansion into new countries such as India. So why should Revolut IPO? If a firm needs to raise capital, then they traditionally have two options. They either raise debt or they issue equity through an IPO. Revolut's investors may wish for the company to go public in order to provide liquidity to shareholders on the secondary market, as opposed to just conducting another funding round. A typical IPO execution process can take about 6 to 12 months. Underwriting is the process through which an investment bank acts as a broker between the issuing company and the public investors. After the IPO is approved by the FCA, the effective date is decided. On the day before the effective date, the issuing company and the underwriter decide an offer price and the number of shares to be sold. According to the underpricing theory, the underwriter should issue shares at a slightly lower price to take into account the fact that most investors are risk averse. Firm commitment. So as a bank, we're willing to make a firm commitment to Revolut. And under such an agreement, the underwriter purchases the whole offer and resells the shares to the investing public. This arrangement guarantees Revolut that the full 500 million will be raised. In a strong sense, the efficient market hypothesis claims that prices will reflect all information that is available, and as a result, there is no arbitrage opportunity for investors. In a semi-strong sense, the only information that can boost returns for an investor is a type of information that is not publicly known. In the weakest sense, fundamental analysis is able to provide an investor with a competitive advantage, and so it is possible to beat the market. It's therefore important for an investor to decide which form of the efficient market hypothesis they believe in, as this will have implications for their future expected returns. Thank you very much for listening to our presentation.